You know, in the world of energy data, things can get pretty high stakes. And 2024, it saw a massive shakeup. Two of the industry's giants, TGS and PGS, decided to join forces in a huge merger. But was this a brilliant strategic move, or was it a really risky bet that would make investors nervous? Let's break it all down.
So here's what we're going to cover. We'll start with how this new Titan came to be and the strategy behind it. Then, we'll check out the amazing early results the company reported, but then, we'll see how the market had a much colder reaction. And finally, we'll get to the big question. Was this whole thing a bold gamble or a safe bet?
All right, first up, let's really get to know the two very different companies at the center of this deal and see how they came together to build an absolute leader in the geophysical space.
So on one side, you had TGS. They were famous for their enormous library of geophysical data, what you'd call a pretty asset-light business. On the other side, you had PGS, a huge operator of a high-tech fleet of seismic vessels, a much more capital-intensive, asset-heavy business. Two very different companies, but you can see how they could complement each other.
So how did the deal actually work? Well, it was a statutory merger, which is just a fancy way of saying one company, TGS, absorbed the other. When all the dust settled, the original TGS shareholders owned about 2/3 of the new, combined company, and the PGS shareholders held the other third. Okay, so what was the thinking here? Why would a company that loves being asset-light and focused on data suddenly want to own an entire fleet of ships? Let's dig into the powerful logic behind this industry-shaking move.
And you know, when you look at it on paper, the logic was pretty solid. I mean, this deal created an unmatched giant in the industry. It gave them full vertical integration, controlling everything from the ships gathering the data to the library that sells it. They brought together PGS's best-in-class hardware with TGS's world-leading software. And underpinning the whole thing was the promise of just massive cost savings. And at first, wow, it looked like they had hit an absolute home run. The company's very first report after the merger, it painted a really rosy picture. Let's jump into those numbers.
Get this. In its very first quarter as one company, TGS posted revenues of over $500 million. That's not just a big number. It was a huge statement about their new scale and power in the market. And it wasn't just about making more money. They were cutting costs like crazy. They were already on pace for about $100 million in annual savings. Way ahead of schedule. That was a key promise to investors, and management was absolutely delivering.
This new financial strength earned them a massive vote of confidence from Wall Street. Standard & Poor's upgraded their credit rating by 3 full notches. Now that just doesn't happen every day. It's a huge signal that you're looking at a much healthier, more stable company.
And the CEO of TGS really captured that optimism in the earnings release, pointing to the record revenue and the fact that they were hitting those synergy goals ahead of schedule. From inside the company, the story was just one of total success.
So, record revenues, massive cost savings, credit upgrades, this thing's a slam dunk, right? Well, not so fast. Because while the executive team was celebrating, the stock market was telling a totally different and much less happy story.
And this is really the heart of the issue. TGS fundamentally changed its DNA overnight. It went from being a relatively safe, asset-light company, basically owning data, to an asset-heavy one, owning and operating a very expensive fleet of ships. That brought in a whole new level of risk and complexity that TGS investors just weren't used to.
Now, to really get why the market was so nervous, you have to look at their biggest rival, Viridien. You probably remember them as CGG. While TGS was busy buying ships and taking on more debt, Viridien was doing the complete opposite, selling its fleet and focusing on being a lean, tech-first, asset-light company. And just like that, you had this fascinating split in the industry. Two giants with two totally opposite strategies.
So, with these two opposing strategies playing out, how did investors vote with their money? Well, the stock charts from 2024 tell a very clear story.
In the year the merger happened, TGS stock dropped more than 20%. Now, Viridien was down too, but by a lot less, only about 12%. The message from the market was pretty clear. They liked Viridien's safer, more conservative strategy way more than TGS's big, risky transformation.
But wait a second, you might be thinking, is that really a fair comparison? How can you compare a stock before and after it's become a totally new company through a merger? It's a really good question.
Well, analysts have a clever trick for this. They create something they call a virtual price. They essentially build a synthetic stock price for the new company before it officially existed. They do this by combining the old TGS and PGS stock prices using the official merger ratio.
That way you get a true starting line for an apples-to-apples comparison.
And here is the punchline. Even when you start from that fair, virtual price, the new TGS stock still fell about 7% over the next year and a half. So this confirms it wasn't just some weird statistical fluke. It was genuine skepticism from the market about all that new debt and the big shift to an asset-heavy model.
Okay, so let's pull all this together. What's the final verdict on this deal? Now that we've got some distance, was it a bold gamble or was it a safe bet?
The consensus among analysts looking back seems to be that the merger was strategically necessary. In an industry that's consolidating, staying small just wasn't an option for either of them. But, and this is a big but, it was also financially challenging. It loaded the new company up with debt and exposed it to the pretty brutal ups and downs of the vessel business.
What this really did was create two completely different stories for investors. You had TGS on the transformational path. It's high risk, but for a potentially high reward, all in a bet to dominate the market. And then you had Viridien on the stability path. Lower risk, aiming for steady returns by just focusing on restructuring and being lean.
And that really leaves us with the big question, doesn't it? In an industry like this, one that's consolidating, which path is the winner in the long run? Is it the bold gamble for total market dominance, or is it the safer bet on stability and focus? The jury is still out, but the answer to that question is going to define the future of this entire sector.